Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. Joining me today are David Parker, Head of MTS Markets International, and Scott Kimball, Co-Head of US Fixed Income at BMO Global Asset Management. We're going to be looking at the way that trading impacts the returns you can get from high-yielding investments. David, Scott, welcome to the show.
Thanks, Dan. Great to be here.
Thank you for having me.
How do you characterize the liquidity, risk, and returns that we typically see for high-yielding assets compared to investment grade and rates markets?
We've seen over the last 12 months some very unusual and historically significant interventions into the credit markets, primarily the Federal Reserve, expanding their balance sheet options to include investment-grade credit and the entry point of high yield. This has a cascading effect on liquidity across the system. We've seen that even a crisis period, a significant amount of investment grade issuance from companies that were under duress in retail, for example, were able to come to market. And as a result of that, investors returned in full force. They felt the strong support from the Fed, almost a backstop, if you will, to credit market liquidity. And this resulted in a tremendous amount of liquidity coming into the high yield market, even across the riskier parts of fixed income. While this is supported of late, and it feels real and permanent, we do think that when there is a risk-off market, there is a possibility of some resetting of liquidity parameters. You start seeing high yield trade a little bit more like high yield, wider bid ask, more volatility, and in some cases, difficulty even moving certain parts of the market.
When we talk about high yielding assets, there is, of course, high yield credit. Should we consider other asset classes as well, potentially EM, given that they have high yields? David, do you want to just talk about perhaps how we think of high yielding assets?
Sure. So, of course, traditionally, high yield would be something rated BBB minus or lower. But in this market where, as Scott said, there's been a lot of liquidity that's been forced into it and assets have been tightening, maybe we could look at it from the true yield perspective, which I would say the high yield market is roughly around 4% yielding. And then you mentioned emerging markets. So it opens up that whole space as something where you could consider almost a part of high yield, in that it shares higher yielding characteristics, obviously risk, and also as a specialty market.
What are the sort of trading challenges that we might associate with high yielding assets?
One of the biggest challenges is that the market has really bifurcated into two buckets, things that don't yield very much and things that yield more. And because of that, there's been this liquidity contagion where liquidity of German bonds, even at negative interest rates relative to positive yields in treasuries, looks remarkably similar. But as we jump over to high yield, we expect to see a little bit more differentiation. And in some cases, we do. So for instance, if you look at parts of the esoteric CMBS market, down in structure, BBB rated or below parts of the CMBS structure, things that are really exposed to principal loss, liquidity there is a challenge. We see these markets in 1 or 2 point bid-ask spreads. Yes, there's been a lot of recovery, but the amount of time required to find buyers is still elongated. So there are parts of the market where you have to be very cognizant of your trading relationships and also be very intentional about valuations and understanding where you think value lies, because the market can be way ahead of you or way behind you. In some cases, it's an opportunity. In others, it's a significant headwind. It feels like if you're only focusing on the big high yield issuers that the market is very liquid, and it is. But as you start dipping into some of these other sectors that you mentioned about, there's some more traditional bargaining power that buyers or sellers have depending on the day.
Broadly, in the high yield space, risk transfer can be a lot more difficult because dealers don't maintain as much balance sheet risk for that space. And therefore, it's very important, more so than most other markets, to find a buyer for every seller or a seller for every buyer. That's where, electronic trading can be beneficial, in particular for the less active names and the smaller players in the space.
Presumably, it also means that you perhaps need to think about how you're going to trade a lot more pre-trade.
Yeah, absolutely. You need to know not only who is trading a given bond or given space, who's good at it, but also where has liquidity been in terms of the price itself, but the bid offer width. And even better, maybe how many bids and offers there have been historically on a bond or a name over time. For extra points, same data in disrupted market scenarios. So we all know that when the market really gets volatile, the liquidity is going to accrete to, the largest issues. What happens to your portfolio in that environment and what happened last time?
So, Scott, with that in mind, does that affect the type of instruments you might use to manage a portfolio, for example, using derivatives or exchange-traded funds?
There's been a tremendous amount of growth in the use of derivatives, particularly in high yield, single name CDS, and also the growth in the ETF market. These are excellent tools to get portfolio proxies for both when you're funding a portfolio, if you want to be opportunistic, but also on the defense side. The one thing that we would caution about liquidity in this environment versus past cycles, even in investment grade, we see there's some single name CDS contracts that only trade, once per day or once per week.
Yeah.
In high yield, there's not quite as robust of a universe, but there's even more instances of single name CDS that doesn't trade quite as much. But index level CDX that gets you hedging the market factor risk is probably the better risk management tool. If what you're focused on is getting a proxy for defending your high yield portfolio against broad market concerns. That being said, our biggest caution in all of this is you saw it a lot last March. We're coming up on a 1-year anniversary of some of that market turmoil. There's a lot of people trading these instruments who haven't necessarily seen that type of market volatility before, a lot of new entrants into the space, a lot of third-party platforms. I think some of them are kind of ingrained to think this Fed intervention is just sort of a freebie that occurs.
Yeah.
There's no guarantee of that in the future. That balance sheet is looking pretty large.
How does electronification potentially help with finding liquidity or price formation?
Electronification really helps the data dissemination and then collection, i.e. where has this bond been? How much liquidity has there been on it? Number 2, where can I find point in time liquidity? And then number 3, in high yield and other liquid paper, how can I as an asset manager reach others who want to take the opposite position?
If you're investing a cash flow into a portfolio, whether you're a traditional asset manager or an ETF, it makes things a lot easier on all of us if we have to buy 3 to 5 million of a bond that's been issued, say, a year ago and it's now off the run, to be able to send that out to the market and reach not just the sell side itself, but people on the buy side who are looking to maybe find a liquid spot for that security. That connectivity is essentially important. And as it expands into places like emerging market debt, both hard currency and local, it can only be better.
There are new players that are moving into the credit space and high yield, whether they're ETF trading firms or coming from some other part of the market. And I think one of the biggest value adds for electronic trading is that it provides those new entrants and others that might want to get involved with a data set to make them comfortable about where things are, how things trade, where the market is.
Do you see that effective trading for high-yielding assets can potentially deliver better investment returns?
There's no question about that. I think on the one hand, earning a liquidity premium, for example, if you're running a multi-sector or a strategic income strategy where you can earn a premium by being a provider of liquidity, that's a sound investment strategy for long-term buy and hold. But there's no question that the market these days, there's a lot of retail money, a lot of asset allocation money from 401ks and individual investors. And those investors need to be able to shift their portfolios to be optimized for, their own risk and return profiles, but also for institutions. Better liquidity, better portfolio results. There's a very strong correlation there, and it's ultimately better for investors.
Scott, David, that's been really good. Thank you so much.
Thank you for having me.
Thanks, Dan.
I'd like to thank David and Scott for their insights today, and of course you for watching. To catch up on our other episodes, go to tradertv.net.